Hello and welcome to the Rask Network. What you're about to hear and see is limited to general financial information only. Please be sure to speak to your financial planner or refer to our financial services guide available at rask.com.au/FSG before acting on the information.
Hello and welcome to this special episode of the Australian Finance Podcast. My name is Owen Rask. And usually when we do these monthly updates, I'm joined by my partner in crime, Kate Campbell, or maybe even Mitchell Snedden, Kevin Fong, or one of the team members who do these market updates with me. But I'm recording from Sydney today. As you can see, if you're watching on YouTube, you can see the lovely windows behind me. But I can tell you for sure, it's still cold. Today, we're going to be talking about a monthly update. I'm going to tell you the returns of some ETFs, the exact ETFs we hold as at the date of this recording. But as you'll find out, some of those ETFs are going to change or will likely change in the not too distant future. As a reminder, you can become a member of one of our investment services, Rask Core, for example, and see what we're invested in, why I'm invested in those, as well as get stock reports and those types of things. So that's all available on the Rask website. You can just Google Rask Core for the subscription option, or if you want to see how we're actually invested, and we do investing for you, that's called Rask Invest. You can go to the Rask Invest website, click on the strategy that you like the look of, and see actually which ETFs we own. And that's updated continuously, so you can see all of them as we hold them. Obviously, if you're a member or you invest with us, you will be told when changes are made. We don't just blindly make them and then not tell you. You obviously get full transparency 24/7. So you can go to the Rask Invest website to see that, or you can become a Rask Core member if you want to take it further. But in this episode, I will be talking about one of the strategies as well as breaking down the monthly performance for June 2024 by ETF. But you may know that in these episodes, in these monthly updates, while we don't answer questions, we do that on the other shows throughout the month, we do take a look at some educational lessons. And I thought a good place to start is, since we've been doing these for a few months now, I thought an educational lesson on economics might be a bit of fun. And to kick things off, I do have a few tongue-in-cheek quotes here from famous investors over the decades who have some less than optimal things to say about economists. Obviously, economists are the people that go on the telly, appear on this podcast, or they are out there in the media. Maybe they're just standing on a milk crate at the city intersection, but they're the ones out there that are saying something about the economy or about how money and how finance is moving in the world right now. I'm going to break down what economics is in just a moment. But so far, we know what an economist is. They're the people that are on the telly. They're the ones that write the headlines. They're the ones that appear for expert commentary. But over the years, I've learned that the future is unpredictable. While it may rhyme, it does not exactly repeat itself. So while the history may be a good indication of what the future may hold, no two economic events, the world is not the same. People use history to justify the future. But if you go back to, say, the 1990s, internet wasn't really a thing. So the world was very different then as it is today. Podcasts weren't really a thing until the year 2000 or thereabouts. And so the world changes, making it very hard to predict what might come next. There's a few quotes here about economists who typically get all of the headlines, but no one really checks to see, do these guys and gals, do they actually have a track record that they could stand on? And if you ask many investors, most of them will say no. They kind of just fill the space. I've got a friend of mine who likes to say when the economist comes on the telly, they go make a cup of tea. But here's some quotes from famous investors through time, which I hope illustrate this in action. So John Kenneth Galbraith once said that the only function of economic forecasting is to make astrology look respectable, end quote. Another one is that if you, this was from Paul Samuelson, this quote, it says, economists have correctly predicted 9 of the past 5 recessions. If you've ever heard the doomsayer predictions, if you've ever read the headlines and reacted, this is where they're coming from. George Bernard Shaw once said, if all economists were laid end to end, they would not reach a conclusion. And one of my personal favorites is that even a broken clock is right 2 times a day. And at the end of the day, a lot of the economic forecasts and the commentary that you hear is simply not reliable. So when it comes to decoding what is happening in the economy and how that translates into your income, your salary, your job, where you might go on holidays, or even your investment performance, it's really important to take those headlines and all the things that you see in the news with a pinch of salt, because at the end of the day, the future is unknowable. Sure, we can all interpret facts and figures in different ways, but in reality, while it may rhyme, it doesn't repeat itself perfectly, and the future is unknown. So what exactly is economics? I want to start this off in a different way. When I was at school, and it wasn't that long ago, if you're younger than me, you're watching or listening to this, when I was at school, there was a subject that we had here in Victoria called home economics. Home economics was the subject where you got to make things. Sometimes they call this food technology. And basically, you would put together ingredients in order to prepare a meal, and it taught you wonderful life skills, come to think of it. But it was called home economics, which always struck me as a little bit odd because my understanding of economics was the stuff that they talk about on the telly. But when you think about it, home economics is about understanding which ingredients go into the thing and produce something on the other end. And if you think about it, economics is very, very similar to that. We've got all of these ingredients in the economy, and what comes out the other end? We try and put things in, and then something comes out. In the Victorian curriculum, I looked this up just before recording, and I found that one of the things that they got students to do in the curriculum is to make a meal as if it was going to be presented to some convention or to some experts. And here's what I got from the website. In this unit of work, students design and produce a savoury breakfast muffin to a standard suitable for entry into a competition such as the Royal Melbourne Show Art. So basically, students are required to make something from the different ingredients. Now, you might think I'm being a little bit weird with this example, but economics is basically how things come together in society or as an individual. And so we break it down in two ways. The first is through something called macroeconomics. And you've probably heard someone say something like, we'll take the macro view, meaning the big picture. And that's how you can remember what macroeconomics is. The other is microeconomics, and I'll get to that in just a moment. When most people think of macroeconomics, they think of things like, quote unquote, the economy. They think of house prices, their wage, or what's going on the news, big picture stuff. They might even see the label on the clothing around them and say, made in China. That's obviously an economy. It's a country, but it's also an economy. And it's an example of globalization in action. It's the big picture stuff. And there's a quote here, which I might show on the screen for anyone watching on YouTube, which is from the World Bank. And this is their definition of what macroeconomics is. Macroeconomics focuses on the performance of economies, changes in economic output, inflation, interest rates, foreign exchange rates, and the balance of payments. So that's kind of like a big, scary thing. Let's break it down real quick. There are a few things that I want you to remember. But if you only remembered one thing about the economy, I want you to remember this idea of inflation. So inflation is just the cost of things going up. When I say things, I mean goods and services. And this is typically measured as a basket of different things. So if anyone like you or me goes into a store and we just bought a few different products, what would be the cost of that today? And what would be the cost of that in 1 year from now? Typically, the difference is measured as a percentage, and that is what you call inflation. This is sometimes shortened to CPI, Consumer Price Index. You'll see that dotted across the media. They'll say inflation in brackets CPI, and that's just an indication of this big basket of different things. Typically, you'll hear about this in the news, and the media picks out the scariest one, because they can do that when they include things like fuel prices, which change daily, and sometimes they're up, sometimes they're down. Inflation is really important to understand because it measures how expensive the world is right now. I remember going to the supermarket recently and buying my favorite cheese, which is Mainland Vintage. Mainland, if you're watching, feel free to send me some cheese because this cheese is very expensive. I know that because I recently checked the price and realized it was over $10 for a block of cheese. If you go back a few years, you would have realized that that block of cheese was only worth about $7. And the reason it's gone up is because of inflation. After COVID, the price of dairy products went up, so the dairy price index, if there was such a thing, went up. That's inflation in action. Another example would be during COVID, the price of puppies went up, one of our most popular videos on YouTube was me explaining why I think the price of puppies would come down after COVID. And sure enough, the price of puppies have come down. In fact, our most recent puppy that we purchased was half the price of the puppy that we purchased during COVID. So if inflation keeps going up, what happens is the prices of all these things keep going up. And if they get too high, they spiral out of control because everyone in the economy thinks that puppies are going to be more expensive next year. I'll buy more puppies this year, which in turn makes puppies this year more expensive and pushes up the price of puppies next year, and so on and so forth. And you have this vicious cycle called hyperinflation. So to control inflation, this is the second term I want you to understand, we have something called interest rates. Interest rates are set not by the government. That's a really important distinction. Interest rates are not set by the government. They are set by a different group of people called the central bank. The central bank is solely responsible for measuring all of these things that we're just talking about and setting interest rates. That is basically all they do, full stop, period, end of sentence. The way that they control inflation is by setting interest rates higher or lower. Think of it like a handbrake or a gas pedal. You've got both in one. When the economy is slowing down and inflation is falling, they put their foot on the gas pedal, they take interest rates away, and you spend more. So inflation comes back up. When it comes back up, they pull on the brake by increasing interest rates, and inflation goes down again. Now, in Australia, the group that sets the interest rate is known as the RBA. In the United States, it's called the Federal Reserve. These are the two names that you've probably heard of. You don't know what they do exactly, but there's the Fed in the US, and in Australia, we have the RBA. The final thing that I want you to remember is this. A lot of people blame the RBA here in Australia or the Federal Reserve in the United States for interest rates being really high and their mortgage going up. But at the end of the day, does interest rates by itself determine whether things go up or down? The answer is no. So there's another dimension to this called fiscal policy. Now, I won't bore you to death with terms any longer, but fiscal policy is basically what does the government have to say about things. So this is actually when Parliament comes in. And if you think about it, when taxes are cut or dropped or taxes are increased, we don't spend as much. So typically, this is what the government does to control inflation. In the last few years, we've seen inflation in Australia go up. The RBA has increased its interest rates to try and slow things down. But the government has kept spending money, which meant that even though interest rates were going up, inflation kept going up to match it. And so we had a problem there. We had this central bank basically fighting the government. And in the end, the government would probably win that one. So just remember that to control inflation, there are two tools. One is called interest rates, and the other one is called fiscal policy, which is determined by the government. Finally, I just want to quickly touch on microeconomics. So we've done the macro, the big picture. Let's zoom in a bit and go microeconomics. Microeconomics, as Investopedia defines it, is studies the decisions of individuals and firms to allocate resources of production, exchange, and consumption. End quote. Microeconomics is basically about how prices are determined and how people react. That's basically it. And the best example of this is imagine you're sitting at home one day, you look out the window and you see a donut truck drive past. You know the ones that look like an ice cream truck, but maybe they sell donuts. Pulls up out front and you think, I could go for a donut. So you walk out. And this time you take your wallet out, you've got your money in your wallet, you've got some cash there and you think, oh yeah, I'll grab a donut. Sure, why not? And the person serves you a donut and this is a $10 donut. So it's a good donut. It's expensive. It's a good one, but you're hungry. So you take it. But then you notice that the person in the truck just keeps making more donuts. In other words, supply is going up. They're making more donuts that you could potentially buy. And then they turn to you and they go, how about another one? Now, this time you're not quite as hungry. So you're thinking, I don't really know. Maybe I could do one more. But this time you think, I don't want to spend $10 and there's so many of them there. I'll give you $9. And the person in the truck says, yeah, that sounds pretty good. I've got heaps here. You can have one for $9. So you give them $9. But then you notice that they keep on making more donuts and you think to yourself, hold on a second. There are a lot of donuts there. I'm not going to buy them all. And they turn to you again and they say, how about another one? And this time you're thinking, I just had 2 donuts. I did not want another donut. So in this instance, you turn to them and you say, listen, I don't know about this. I'll take one, but I'm not going to eat it now. I'll give you $5. And they go, yeah, I've got heaps of donuts. You can have one for $5. And so what we can see is that demand, that is you wanting to buy another donut and eat it, is falling. Meanwhile, supply is increasing. This is what we call the laws of supply and demand, is that the more supply there is, the lower the price should go. The higher the demand is, with limited supply, means prices should go up, because if there's not that many things to buy and you want to buy it, it means that you might need to compete against other people for that thing. This is a lot of the reasons why auctions don't work, at least for you as the buyer, because there's only one property to buy and you've got to compete against the other people who have heightened levels of demand. That's why I'd never buy a property at an auction, at least not without the help of a professional. So in this example, we can see the famous rule of economics, which is supply and demand, playing out in action. Eventually, if we did this donut example again and again and again, eventually what we would find is that if we got enough people around the donut truck, we'd all kind of agree that there's a fair price for the donuts. And the person on the other side will stop making donuts because they'd realize there's no point making anymore. I can't sell them. That's what we call equilibrium. That's where supply meets demand, and that's the price. So there you have it. You've got macroeconomics, which is the big view, and you've got microeconomics, which is the individual view. When you see companies in the wild, say like Gucci, Ferrari, Nike, and all of these brands, you'll notice that they have something in common. They have a high price. You could buy a t-shirt at Kmart, but you go for Nike. Why is that? Most of the time, they're made from the same material. They last the same amount of time. They fit the same way. The difference is the brand. A brand like Nike or Gucci can mean that a company can charge more for a product even as supply goes up. So even as more t-shirts are made by Nike, or even as Ferrari makes more cars, they can sustain the price because they know that there's so much demand and they control supply. So when I'm investing, I always look for that. But this is an example of microeconomics playing out in action. And you can go on the media and you can see many examples of macroeconomics playing out. And if you go to your children's school, you might even see home economics playing out in action. So that is economics in a nutshell. And we've spoken about it plenty of times on the show, but it leads perfectly into what I'm about to talk about for this month's portfolio update. A few things that we've noticed over the past month, and I'll get to the ETFs in just a moment, which is that in Australia right now, it's expected that interest rates will not be cut in 2024. At the beginning of the year, on January 1st, if you had asked me, will interest rates fall this year? I probably would have said, well, I don't know. But secondly, I would have said, well, it seems likely. Inflation was seemingly under control and falling. And what happens when inflation falls? Maybe interest rates get cut to keep the prices of things going up sustainably over time. But what we've found is that inflation in Australia has been quite persistent. Inflation is still riding high, as you might say. So it's unlikely that interest rates will come down this year. At least that's what the consensus is. According to something that you can Google online, something called the RBA rate tracker. The RBA is the name of that thing that I mentioned before, the central bank. By the month 2024, using the RBA rate tracker tool, you can see that there will be no change to interest rates. That's based on current expectations. Now, if we go away and we look at the United States, we can now see that in the United States, they still expect interest rates to be cut from just over 5%, which is where they are currently. However, on January 1st this year, if you had asked an economist or a media commentator, say like an equivalent of me in the United States, you would have found that interest rates were expected to come down 3 times in 2024. Fast forward to now, it's only expected to fall once, meaning probably 0.2% or 0.25% lower by the end of the year. So in Australia, we do not expect interest rates to fall. That's bad news for mortgage holders like myself. Good news for retirees. In the United States, we still expect a small reduction in interest rates, but not to the extent that we thought at the beginning of the year. So what does that mean? What does it all mean in practice? Well, this sets the scene for how our portfolios performed in the month of June. Now, I'm going to use some numbers, and it's really important whenever I mention numbers and I talk about portfolios, that you go and refer to the Rask Invest PDS or product disclosure statement, which is available on the Rask Invest website, as well as the target market determination or TMD. Remember that past performance is not indicative of future performance, and that you should seek the advice of a licensed and trusted financial planner before acting on any of the general information that I'm about to talk about. All of the ETFs that I'm about to talk about also have PDSs of their own, which are available on the provider's website. What that means is if I talk about, let's say, a Vanguard ETF, you can go to the Vanguard website and read the PDS, the product disclosure statement, which will tell you what you need to know about that ETF. Now, I'm very pleased to say that as of June 30th, 2024, all of the 3 Rask Invest strategies were positive since inception, meaning that the results are now in the green or back in black. And I'll read through some of the returns of the various ETFs for the month of June. But the 2 that I want to highlight, and I'll maybe start with these, are the United States ETFs, the US stock market ETFs that we invest in. We have IVV, which is the S&P 500 ETF. And you will know that if I use the IVV, the 3 letters or the 4 letters, I'm talking about the ticker symbol, which you can Google IVV ETF, for example, and you can find out information about that ETF, as well as the IHVV ETF, which is the same S&P 500 ETF, but with currency hedging in place. Now, I remember at the beginning of June, people were saying to me, the United States stock market, it's so high, it can't go any higher. Are you worried? In the month of June, the United States stock market returned over 5% in 1 month, 5% positive. So it's just as people were saying, it's so expensive, can't go any higher, it went higher. And that's because in the short term, it's very unpredictable what the stock market or really any investment will do. I typically measure investments over 3, 5, or 10 years. But in this instance, all I had was 1 month because it's a monthly update. And we can see that both of these ETFs returned over 5% in total return terms. And that caught me by surprise, but it definitely did some of the heavy lifting for a lot of you who invest in the United States stock market and in diversified portfolios. Now, there are many reasons why these ETFs may have gone up. One of the reasons that you might be able to kind of rationalize is that we're in a US presidential election cycle where it looks like it's kind of neck and neck between Joe Biden and Donald Trump. Maybe the Republicans win. Maybe under Donald Trump, we see Donald Trump return to the Oval Office, and maybe that's good for business. Another thing is we have seen that, as I just mentioned before, that over time, slowly, people and commentators in the United States have expected that interest rates will be cut. So what that means is as interest rates are cut, people then look for other investments to put their money in. So if I was expecting the interest rates of my term deposit to come down, I might be inclined to invest that in shares so I can get more income. And so we've seen more people, by the looks of it, investing in the United States stock market and thinking that maybe that's a good place to park some money. If I move down the portfolios and I bring it back to Australia, the VAS ETF, the Vanguard Australian Shares Index Fund ETF, returned just under 1% in June. And that was quite interesting because, again, this is business as usual, nothing to worry about when an ETF goes up or down by 1 or 2% every month. That's just normal business. And we saw that it was positive in the month of June. There's really nothing you can glean from that. But there are some interesting things that are further down in our portfolio, at least when I look at it. And that is from our 2 bond ETFs, the IAF ETF, which is an Australian government bonds ETF, and VBND, which is the International Bonds ETF. Both of those were positive of different amounts. The US ETF went up more than the Australian bond ETF. While it's still positive, it didn't go up as much. These are really interesting movements for me because when I look at my portfolio and I see bonds going up, what that typically means is interest rates are expected to go down. Now, the key thing is here is that when people think about the movements of bonds, they're very unpredictable at different times. They don't understand them. Actually, even many financial advisors don't truly understand why bonds do what they do. But typically, when people expect or the market expects that interest rates will come down, a bond ETF will go up because the way it works in an ETF is that the bonds inside of that ETF that have higher interest rates now will be worth more in the future. So the price goes up. And we've got many explainers on the website that help you understand that. But basically what we saw in the month of June is bond prices going up, like the bond ETFs going up, at the same time as stocks going up. Really, the big negative for the month was some parts of the emerging markets. So this would be like China and these types of places didn't perform as well as I would like and as many investors would like. If you are using a term deposit, you can get a term deposit for around about 5% interest at the moment. As you know, we don't have any affiliation with this bank, but I'm just going to mention it because I know many of our community use this bank, which is ING. ING, according to their website as of today, the 16th of July, is offering just over 5% in a 1-year term deposit. Go back a few years and retirees would have done anything to get a 5% term deposit. Well, now you've got it. And there are many other banks that offer around about 5%. If we move over to the highly unregulated land of cryptocurrency, we can see that Bitcoin in US dollars is now $65,000, and that's in US. So that's up 46% in 2024 so far. So every time I look at those numbers, they change, but that's an indication of where things have gone. And the final thing for any people that are looking to travel, which I will mention, is that the Australian dollar, as in compared to the US dollar, is around about 68 cents. So it's been rising pretty quickly over the past little while. And I know that might give some cause for celebration, particularly if you're going to the United States on a holiday. Maybe if you're going to Disneyland or Disney World or one of those, it might bring some more purchasing power when you convert your money. But what it basically means, and this is quite interesting for me as someone who just got back from overseas and saw the currency falling just as I was converting money, which is a bit hard to swallow. But the reason why you typically see the Australian dollar go up is if our interest rates, remember that thing that we talked about before, is if our interest rates are expected to go up versus the United States. So remember what I said before is that we do not expect Australian interest rates to fall anymore. Meanwhile, in the United States, they're still expecting interest rates to come down a little bit. Now that creates an opportunity for people who might think, well, I'll put my money in Australia where I can get potentially higher interest rates for a little bit longer than I would in the United States. And so you can see this interest rate disparity. You could maybe put money in Australia and get a good interest rate for a bit longer than keeping money in the United States. So what happens? Supply and demand kicks in. And all of a sudden the money can shuffle from the United States to Australia and push up the price because of supply and demand. Everyone wants Australian dollars, so it goes up. And we see this, while this is not something that you could necessarily bank on, or maybe we do not trade on this type of information, you should be mindful that that's typically how things work. If one currency is worth more than another one, or it's expected to be worth more, money will flow to that. In the same way that money going from stocks to bonds or cash or to property or for a house deposit or to savings, money has to go somewhere. And that's always the thing that's been quite interesting to me when people call for a stock market crash. They say the stock market's about to crash. Quick, do something. And I think to myself, well, where would I put the money? It's got to be somewhere. Put it in cash, put it in bonds. What do I need to do? A lot of those headlines have no educational value whatsoever. So normally when I see someone say something like that in the media, I say, what should I do? Where should I put my money? How much of it? Because they don't have that substance or that ability to educate you. That really, money has to be somewhere. And if you're investing for a very long period of time, you should probably have the majority of your money invested in the stock market or property, because those two things tend to add a lot of value to your wealth. Whereas the headlines definitely distract you. So in the month of June, most things were positive, which is very rare. I remember talking to an investor recently who was looking to invest with us. And I said, I've got this Apple Stocks app on my phone. And every day when I wake up, I look and I check to see how the US market did overnight. And then at the end of the day, I just glance at it to look and see how did the Australian market and all the different types of investments and ETFs go. And that's basically the extent of it. And for some days in June, I remember looking at it and thinking, wow, every single investment on my watch list is green. And that is not normal. It's not normal that you wake up and literally everything's green, from cash to bonds to emerging markets to US shares to Australian shares. That's not normal. What's normal is that things move in different directions at different times and at different magnitudes. That is normal. And that is the cost of investing. There is a bit of discomfort that you get from being invested throughout the markets, but that is the true price. You've got to pay for that discomfort. And in order to get those long-term returns, you've got to wear that in the short term. Now, finally, I'll refer you back to the Rask Invest, or if you're a Rask Core member, go and check out the websites for more information. But I would say that we try to make these market updates as informative as possible. So if you don't like the educational part, let me know. Write up some feedback in the comments if you're on Spotify, or just send us a message where it says ask a question. You can also use that to give us feedback on any of our podcasts at any time. All of our hosts are really receptive to all feedback, and we just want to get better and serve you better. The other thing that we try and do with this market update is cut through the noise. And 9 times out of 10, or maybe 11 months out of 12, when we do these, we will be here to say, there's probably nothing to worry about. We haven't come across anything. The data doesn't suggest that. Of course, things can change, and we know that the stock market crashes on average approximately every 4 or 5 years. Now, many of those are unpredictable, so we just have to kind of roll with them when they come. But by being diversified, by dollar cost averaging, you get some of the high prices, some of the low prices. You're diversified, so things move in different directions at different times, and you can feel a bit more comfortable at night. If you need to learn more about that, you can head to our free ETF investing course, which is available on Rask Education. You can shoot us a message over on the Rask Invest website, jump into the Rask community, which is also free, and just say, hey, I listened to the latest podcast. Owen said this about this. What does it mean? I'm in there every day responding to questions. So you can use that as a resource, and you can share it with your friends and family as well. But just for the month of June 2024, I'm so thrilled to say that we've made it this far with our Rask Invest service. Our first financial year, our first full quarter of reporting. There's an update out on the Rask Invest website in a few weeks. So go and check that out. We learnt about economics, microeconomics. Remember the donut example of too many donuts means prices fall, not enough donuts or Gucci handbags mean prices go up. If you haven't already, home economics, go and check it out. It's a great course of study, and I'm benefiting from it today. I can tell you that much. I'm sure Kate is as well, no matter where she is right now. If you want to learn more about our investing, you can head to the Rask Invest website. There will be a link in the show notes. You can also book a call with our head of funds management if you want to learn more, or tune in for one of his weekly updates on Rask Invest and the portfolios. That's it for this week and this month. Hopefully next month, for the month of July, as we do our market update, Kate will be back with me and we'll be doing another one of these updates together. But that's it for now. Don't forget to send in your questions, and I look forward to seeing you in the next episode.
Thanks for watching this video on the Rask Network. While you're here, don't forget to like and subscribe so you can get videos each and every day on business, finance, investing, and so much more.